Before we begin, let me ask you a question. Why is Bitcoin valuable? Interestingly, most people who buy Bitcoin cannot truly answer this question. They buy Bitcoin simply because its price seems to have been validated by the market again and again. When people around them talk about it, when the media keeps reporting on it, and when the price keeps hitting new highs, all of this creates an illusion. It feels like it must have value. In simple terms, Bitcoin's value comes from consensus. People believe it is valuable and believe it will keep becoming more valuable. But we need to understand that this kind of consensus is essentially emotion and belief. And belief can change and can break. As investors, if we do not even understand what this value foundation is, then how is this kind of investment any different from gambling? So if you want to truly understand Bitcoin's intrinsic value, make sure you watch until the end. Today's video will help you build a much clearer understanding of Bitcoin. To truly understand the nature of Bitcoin, we must first acknowledge one thing. Bitcoin has achieved something that no one managed to do over the past thousands of years. For the first time, it gave ordinary people ultimate control over their own assets. In the traditional world, whether it was ancient vaults or modern banks, your wealth was never fully yours. You deposit your money with a bank and it looks safe. But in reality, your assets completely depend on the institution's credibility. Once the institution runs into trouble, your wealth suffers as well. Take Australia as an example. Each bank account is only protected by the government up to $250 thousands. If a bank fails, any amount above that limit is not protected and could theoretically be lost entirely. This is not a hypothetical scenario. It is a real institutional risk. Another example is Silicon Valley Bank, which collapsed in 2023. At the time, the bank held more than 170 billion in deposits, and about 90% of them were uninsured. Although the government eventually stepped in and prevented a systemic crisis, for several days, many companies and depositors faced the real risk of frozen funds and no access to their money. These examples all point to one reality. In the traditional system, your wealth always depends on external institutions, not on your own control. The emergence of Bitcoin completely changed this rule. In the Bitcoin system, asset security no longer relies on banks, governments, or any centralized institution. It is built on mathematical rules and global distributed network consensus. In this system, a private key is not just a string of numbers. It represents absolute control over your assets. As long as you securely hold your private key, no one can take away your ownership. This is the first time in history that humans have gained a form of asset ownership that is almost impossible to confiscate. At its core, Bitcoin represents a shift from institutional trust to mathematical trust. It transfers asset control from external institutions to individuals. You no longer need to trust that a bank will not fail. You no longer need to assume an institution will always act fairly. You only need to be responsible for your own private key. This is what decentralization truly means. And this is Bitcoin's most revolutionary innovation. But this breakthrough did not come without a cost. To achieve true decentralized consensus, Bitcoin paid a price that is often overlooked. That price is privacy. This level of transparency is a necessary requirement of a distributed consensus system. In a system without a central authority, no one can vouch for you. Every node must independently verify that each transaction is valid. To make this possible, transaction information must be visible to the entire network. Because of this, the Bitcoin blockchain has become the most transparent, most durable, and most easily analyzed financial record system in human history. Every address balance, every transaction amount, and every transfer timestamp is permanently recorded on a globally shared ledger. These records are public, cannot be altered, and cannot be deleted. They exist simultaneously on thousands of nodes around the world. In other words, once a transaction happens, it stays on the chain forever. This also means that in order to gain asset control through decentralization, Bitcoin objectively sacrifices privacy. In the traditional banking system, your account balance and spending history are private by default. Ordinary third parties cannot see them. These records are only disclosed through legal procedures or explicit authorization. But in the Bitcoin system, transactions are public by design and anyone can view them. This is not a flaw. It is the result of intentional design. At a fundamental level, Bitcoin is an extremely transparent system. It trades public verifiability for asset control that does not rely on trusting any institution. This is the cost of decentralized consensus, and it is a choice that was written into Bitcoin's structure from the very beginning. But why has this privacy issue of Bitcoin been ignored by so many people for such a long time? The reason is that most people confuse two completely different concepts: anonymity and privacy. Many people feel that Bitcoin's transparency is not a big problem because what they see is a surface-level anonymity. On the Bitcoin blockchain, you only see an address like ABC123 showing that it holds 100 Bitcoins, but you do not know who this address belongs to in the real world. So people naturally assume that as long as no real name appears on-chain, that means privacy exists, but this is a very dangerous misunderstanding. Privacy refers to who can see the information. In a system that truly protects privacy, transaction details themselves are restricted. In the traditional banking system, your account balance, transfer records, and spending history are private by default. They are only visible to you and the bank, and unrelated third parties cannot access them. On the Bitcoin blockchain, the situation is exactly the opposite. All transaction details are publicly visible to the entire network, with no real privacy protection at all. What Bitcoin actually provides is not privacy, but anonymity, or more accurately, a pseudonymous system. Your real name does not appear on-chain, but your address itself acts as a long-lasting pseudonym. You can think of it like this. You register a social media account and choose a random username, such as ABC123. You post some aggressive or controversial opinions, and at this stage it has almost no negative impact on your real life. That is because no one knows who is behind the account. It is a pseudonym disconnected from your real identity. But once one day that account is confirmed to be you, maybe through doxing or other ways of linking it to your real identity, everything changes instantly. Every post you ever made and every word you ever wrote will be dug up, re-examined, and directly affect your job, relationships, and social reputation in the real world. Bitcoin addresses work in the same way. The difference is that they do not record a few comments. They record all your assets and your entire transaction history. Once this pseudonym is linked to your real identity, all your past, present, and future on-chain activity becomes fully exposed, with no protection at all. This pseudonymous system has already been broken in the real world. A very typical case is the Jianwen case investigated by UK authorities. Jianwen used Bitcoin for a long time to move and hide illegal funds. These wallets had no names or identity information on-chain, and they looked no different from countless ordinary addresses. In the end, UK authorities used on-chain analysis techniques combined with a few real-world touchpoints to successfully link these addresses to her real identity. As a result, they seized around 61,000 Bitcoins. At the time the case was exposed, these assets were worth more than $1.4 billion, and later the value once exceeded $3 billion. This became one of the largest crypto asset seizures in UK history. What is shocking is not the amount, but what it clearly tells everyone. Once on-chain identity is linked to real-world identity, Bitcoin's so-called anonymity collapses almost instantly. This is why Bitcoin's anonymity is actually extremely fragile. Once identity linkage is broken, you instantly lose all privacy. It is equivalent to being fully exposed on-chain. How much you hold, when you transferred funds, who you sent them to, and how your money flows can all be analyzed by anyone. The more realistic problem is that this identity linkage is actually very easy to break. Modern on-chain analysis technology is already highly mature. Even if you do not actively reveal your identity, analysts can infer your usage patterns through transaction behavior, fund flows, and habits. They can even estimate your geographic region and behavioral profile. And once you have ever bought or sold Bitcoin through an exchange, such as a compliant platform like Coinbase that requires KYC, your on-chain address is almost permanently tagged. Your entry point is recorded, and your exit will eventually be identified as well. Many people comfort themselves by saying that as long as they keep their Bitcoin in a cold wallet and do not touch it for 10 years, no one will know it is theirs. But in reality, the opposite is true. Large wallets that stay inactive for long periods are often easier to identify and become priority analysis targets. As soon as you interact with the real world once, whether buying, transferring, or cashing out in the future, the entire on-chain history could be linked together instantly. The reality is that many people live under the illusion of privacy while actually existing inside a highly transparent and traceable system. This is not a conspiracy theory. It is a structural outcome of how Bitcoin is designed. So in the end, we must return to the most fundamental question about Bitcoin. Is it really worth being assigned such a high value? Objectively speaking, Bitcoin did achieve a revolutionary innovation. Through mathematics and distributed consensus, it gave individuals final control over their assets for the first time in history. This is its most important and almost irreplaceable source of value. But at the same time, to achieve this decentralization, it paid a very clear price. It largely gave up privacy and relied on a pseudonymous mechanism that offers only a very fragile layer of protection. From this perspective, Bitcoin is more like a tool for extreme scenarios, not a universal asset suitable for everyone. The people who truly need asset control that does not rely on any institution are often a small group of high net worth individuals trying to avoid sovereign or institutional risks, not the average investor. At the same time, if Bitcoin is viewed as a store of value, its volatility is far higher than traditional safe haven assets like gold. This means it is not a mature or stable value anchor. In other words, Bitcoin solves a very important problem, but the scope of that problem is much narrower than many people imagine. So in my view, Bitcoin's value does exist, but its ceiling is limited and far less solid than the label digital gold makes it sound. It is more like an experimental asset that the market is still testing and debating, rather than something I would be willing to hold as a long-term core investment. Of course, the final judgment is always yours. At least now, you have a clearer understanding of what Bitcoin actually solves and what it sacrifices. If you believe its value far exceeds its current price, then buying it is your choice. But at the very least, it is no longer just a mythologized symbol. All right, that's it for today. I'm Ryan, and I'll see you in the next video.